You've all heard of the one big beautiful bill by now. It reawakens the qualified opportunity zone from the Tax Cut and Jobs Act by giving ridiculous tax incentives to invest in low-income communities. But it underwent some changes and has a lot of people complaining about this window between 2025 and 2026 called the dead zone. And I'll show you the workaround, by the way, to get outside of that dead zone. So if you're about to sell a property, a business, a huge block of stock, there's a clean way to push that capital gain tax down the road and potentially make the new growth tax-free. It's not a trick. It's the Qualified Opportunity Zone Fund or Qualified Opportunity Fund. We'll call it QOF rules. But like I said, there's a catch most people miss. Between 2025 and 2026, these are awkward years for new Qualified Opportunity Fund money. In this video, I'm going to show you how the timing works, why those 2 years can be a dead zone, what to do if your sale lands there anyway, and how to set you up so you can get the 10-year benefit of this tax-free money actually that hits your account instead of leaving it on a spreadsheet. You'll get the full playbook, who a Qualified Opportunity Fund fits, who it doesn't, how the 180-day clock really works, and where people mess up the paperwork, and I'll give you kind of a simple decision tree. No hype, just the steps. So what do Qualified Opportunity Funds do in 1 minute or less, right? I'm just going to break this down. You sell something with capital gains, think stocks, a rental property, business. You reinvest the gain amount, not the whole sales price, this isn't a 1031 exchange, into a Qualified Opportunity Fund. You have to do that within 180 days. That move defers your original gain. If you hold that Qualified Opportunity Fund investment for 10 years beyond, the appreciation inside the Qualified Opportunity Fund can be tax-free when you exit. In other words, there's no tax on any of that gain, and it goes on for a long period of time. There are intermediate rules, like you have to have a 5-year inclusion timing and fund level tests that the operator has to meet. That's their job. Your job is just the timing and the paperwork and picking a competent fund, but their job is they have some things they have to do, but that's the spine of it. Now the timing nuance that trips people up, and this is really why 2025 and 2026 feel like a dead zone. The simple version, a lot of new improved Qualified Opportunity Fund benefits really matter for gains invested after the 2026 year end, when the refresh designation cycle and investor level timers line up cleanly. If you stuff gains into a Qualified Opportunity Fund during the calendar 2025 year or 2026, you're going to have a short, awkward deferral. The date your deferred gain is recognized, which means, hey, the money I put into it, I'm going to have to recognize, can come too soon to be useful, i.e. it's going to be deferred until 12/31/2026, which gives you like very little time value. You also have weaker basis step-ups for these transitional quirks. The newer basis and inclusion rules that help weren't fully aligned yet for mid-transition investments. Add that many quality operators are staging products to launch with that 2027 to 2036 designation window, and we have an issue. Capital placed in 2025, 2026 might sit or get deployed in less attractive projects just to meet the test. Plus, just to give you another headache, there's state conformity issues. Several states lag the new federal timing. In other words, this just came out and the states haven't kept up. Transitional year investments can make your state return pretty messy without adding much benefit federally. So the fact that the Qualified Opportunity Zone funds were going bye-bye up until the one big beautiful bill, now they're back, but it's creating some timing issues. But if you can control the timing, there's ways. Most investors are better off queuing up their fund choice in funding in early 2027. You get to keep the 10-year appreciation benefit cleanly, and your 5-year inclusion date lines up with the new cycle, not the tail end of the old one. And what do I mean by that? Let me just give you a real quick. If I have gain, let's say I have $100,000 of gain, and I invest in something now, I have to recognize it as though, for 2026. So it's not a lot of time that it's getting in there. And then I just have to hold that for 10 years, which is great, and I can avoid gain on the things I invested in. And I'll go over some examples in a little bit. But if I can wait till 2027, I'm not forced to include that until 2032. But you're saying, Toby, my sale lands in 2025 or 2026. So now what? You still have options. The goal is to preserve flexibility so you can make a smart qualified opportunity fund contribution when the rules give you the most mileage. My thoughts, spread the gain. If your buyer is open to it, use an installment sale so the part of your gain hits, the big part, like make it the most of it in 2027. I'm talking about you could do like a balloon where, hey, pay me a little bit for now, in 2027 it all comes due. Now you have a clean new cycle gain that can feed a qualified opportunity fund on a better timeline. So here's the idea in plain English. You sell on the installment method, take tiny principal payments in 2025 and 2026, then a big balloon in 2027. Each year's capital gains portion of the payment is its own eligible gain. Each one gets a fresh 180-day window to roll into a qualified opportunity fund. So the 2027 balloon's gain can be contributed to a qualified opportunity fund in 2027. And you ride the cleaner post-transition rules, this longer deferral, plus there's a step up of 10%. Now let's discuss the mechanics and guardrails to protect yourself. Right, an installment sale spreads gain recognition over the years you receive payments. Right, that's what it's about. You report the gain portion each year. I believe this is Form 6252. Only the gain, not the basis recovery or interest, can go into a qualified opportunity fund. For installment sales, the regs and IRS FAQs let you start the 180-day window, the qualified opportunity fund clock on the date that you receive, get this, each payment, or alternatively, the last day of the tax year. That's what allows the 2027 balloon to be qualified opportunity fund eligible in 2027. Here's an important do not do this thing. Don't pledge the note. You'd sell it on an installment note. Don't go sell that note or pledge it for a loan. The pledge rule treats loan proceeds secured by the installment note as if you got paid, accelerating that tax. Avoid using a buyer's note as collateral or monetizing it, or you're going to have inclusion right then and there. If the installment strategy does not work for you, consider using alternative deferrals for the 2025, 2026 years. Depending on the asset, consider like a 1031 exchange or a Delaware statutory trust, which is for real estate only, or structured sale or charitable truths, for example, like a CRT to soften the tax in those transitional years. Then use the qualified opportunity funds for 2027 plus gains, for after that point when the benefits are fully aligned. You don't have to force a qualified opportunity fund in a year that doesn't help you. Keep your powder dry if the math says wait. Now, back to how the qualified opportunity funds work. You also need to be aware of the 180-day clock. This is how most people blow it. They think the 180 days starts when the money hits their bank. For marketable securities, that's close enough. But for partnership, LLC, K1 gains, you may have a different start date, which is often the last day of the partnership's tax year or the K1 issuance window. They then like to wait until the last minute, let's say day 160, to look for a fund, so you got no time. This is how you end up with a weak sponsor. They invest the wrong amount too, we see that. You invest the gain, not the basis. So you're like, it's just the amount that's actually capital gain, not the entire amount of the sale. We've also seen people try to loan a fund money or do a hybrid that needs to be equity in a qualified opportunity fund to qualify. So now that we know we have 180 days to find a fund in the qualified opportunity fund, we need to find one. By the way, the qualified opportunity fund also has timing rules to deploy the money, right, which is a topic for another day. But if you're interested in being both the investor and the operator for your own fund, you'll have additional time to find an investment in a qualified opportunity zone. But like I said, that's a topic for another day. I've seen too many people just screw up the fund. So I prefer to stick to setting, or basically sitting in the investor seat. Speaking of which, let's talk about who a qualified opportunity fund actually fits. It's a good fit if you have a large capital gain you'd rather defer. B, you can live with a 10-year hold. Like, I don't need the money right now. You want equity type upside with a chance to zero out all new growth. And you can pick a sponsor who actually executes. They have compliance plus great projects. It's a bad fit for you if you A, need the cash back in a few years, B, are already stretched thin on liquidity, C, hate multi-year holds and fund structures, or D, are prone to changing strategies every 6 months. You're one of those people that can't decide on something and stick with it. There's nothing wrong with passing on a qualified opportunity fund. It's a tool, not a religion. Now let's review the moving parts of a qualified opportunity fund. Let's go to the investor side. You elect to defer your capital gain by investing in a qualified opportunity fund within 180 days, right? You file the election with your return. Keep filing a simple information form each year that you're holding it. On the fund side, the qualified opportunity fund must keep 90% of its assets in qualified opportunity zone property, follow substantial improvement rules for most property, and meet deployment timelines. But that's on the sponsor, not you. But you should ask how they track it and who audits it. They'll let you know if you have a really good sponsor, right? At a set point, think 5 years from your investment under the new framework. I'm talking about the stuff that kicks in 2027. Your original deferred gain comes back into income, not the fund's appreciation, just the deferred piece, the piece that you wrote off. It's a 10-year switch. Once you hold for 10 years, then you can sell and exclude the appreciation of the qualified opportunity fund interest. That's the juice right there. To help make this make sense, let me give you an example. Let's say Bill sells a piece of real estate or stock in a company, and he has $1 million of gain in 2027. Bill invests the entire gain in a qualified opportunity fund, not the entire sale price, just the gain, and he holds it for 20 years. And it makes $5 million in gain after that 20 years. So nice job, Bill. But how do the taxes work? Well, firstly, Bill would defer the $1 million in gain for 5 years. No tax in 2027. In 5 years, Bill would pick up the deferred amount, plus he gets a step up in basis of 10%. So Bill would only owe tax on $900,000 rather than the full $1 million because he has that 10% step up. So assuming he invested in a qualified opportunity fund in 2027, he would pay tax in 2032 on $900,000 of gain. Assume that he's in the highest tax bracket plus the net investment income tax. His tax rate would be, from a federal standpoint, 23.8%. So you multiply that by $900,000 and you have $214,200 in federal taxes. Now he sells it 20 years later, right? From when he bought it for $5 million. So in 2047, 20 years later, he exits with a $5 million gain. Now the first thing you do is subtract off the $1 million in original basis. So he has a total gain of $4 million. But the entire amount, get this, is stepped up to the fair market value on sale. Meaning, in English, he pays no tax on the $4 million in gain. Nada, zero, zilch, no tax. That's why people do this. Put it another way, Bill would only owe tax on the gain he recognized in 2032. So he only paid $214,200 in the entire gain. So he paid $214,000 on $5 million of gain. Nice. But how do you pick a fund? All right, I'm going to give you some easy rules. Ask these and expect clear answers of anybody asking you to invest. For their pipeline, What assets are already under control and what are the timelines? For compliance, who is your tax counsel? How do you monitor the 90% tests and substantial improvements? Can I see last year's compliance letter? For fees and waterfalls, what's my net if you exit in year 7, 10, 12, 20? Operatorship. Is this real development chops or is this just a marketing deck? In other words, are the operators experienced or are they just pitching something because they know it's hot? Reinvestment plan. If you sell an asset earlier, how do you handle the inclusion event risk? Is there a way to roll it? Yes, there is. Are they aware? That's what you're asking. If they can't answer simply, that's your answer right there. So qualified opportunity funds are back with a vengeance, albeit you might have to wait a little bit because we all thought they were gone, right? We thought they were toast. They weren't really that great in the last year or two because you didn't have long deferral, but they are back now. And realistically, I say 2027, but you could sell in the second half of 2026 and defer into a fund in 2027. If you have to sell in 2025 or earlier in 2026, then there's still alternatives. I mean, remember, we talked about the installment sale and things like that, but you can still do a 1031, deferred Delaware statutory trust, which is for real estate only. You could keep full deferral without locking into qualified opportunity fund timings there, but you could, the best things is probably doing that installment sale, the structured sale I told you, the spread gains. It lets you land a big chunk of them in 2027 for a qualified opportunity fund. If you can't wait, the share remainder trust still work. It defers and diversifies. It pays you income and then a charity later. A qualified opportunity fund could also be used on other gains in future years. You could do partial harvesting. Hey, you don't have to do everything in one tax year. Stage your sales so that your cleanest gains line up with that qualified opportunity fund funding windows, the 2027 and beyond, that actually help you. And if you can't wait, then you could also use charitable planning, the short-term rental loophole, real estate professional, harvesting and capital gains, oil and gas, and a bunch of other tax strategies to lower your tax bill. You get the idea. There's a bunch of them out there. You always have choices if you work with somebody who knows your options. And by the way, you want to know? Like, subscribe, and share. Like, make sure that you're watching this channel. Plus, leave your comments below. We'll answer them. If you'd like to speak to somebody from my offices, feel free to use the link in the show notes to get a free consult to see what strategies might help you. In the meantime, check out my recent video, the new 100% write-offs under the big, beautiful bill. There's a lot of incentives in there and you could save a ton of money. So check it out. Good luck.